Hello and welcome to Reimagine version 14, our university edition. If this is your first time joining us, welcome in. And if not, welcome back. We've interviewed over 600 projects, teams, and thought leaders in the space. And the goal of our virtual conference is to educate and inform all, including those new to the crypto space, long-time holders, and industry professionals. So make sure to subscribe below to keep staying informed and enjoy what we have in store for you this afternoon. And today we have returning once again to our conference series, Bitcoin entrepreneur and influencer, Mr. Dan Held. Excited to have you once more, Mr. Held. How are you doing today?
Doing well. Thanks for having me.
And before we move into introducing the student panelists and my co-hosts, maybe you could tell us a little bit about your career and the Bitcoin DeFi that you are here to kind of discuss with us today.
Yeah, so I've been in this space almost 10 years, built my first product in 2013 called Zero Block. We got bought by Blockchain.com, and I was the first product manager there. So almost in the space, it's almost 10 years now. For me, Bitcoin always represented our best chance for freedom. And I think financial freedom is the most important freedom one can have. Who cares if you have freedom of speech if you have no agency over your body in regards to money, or you're not able to move or influence anything because your money's frozen. So for me, money is the core root and the core solution that we need to solve for. So after Zero Block, worked at another crypto startup. Then I went to go work at Uber for 2 years. Uber headquarters on rider growth and growth marketing. And then after that, created another startup, which we got bought by Kraken. At Kraken, I built out the marketing org. So my the TLDR of my narrative is almost 10 years in crypto and about 7 years in a growth marketing function. Growth marketing is user acquisition for those who don't know what the term means. In parallel, I've grown my audience to about 850,000 followers on social. People follow me because I explain Bitcoin simply. I talk to the newbies. I don't talk to the existing Bitcoin hodlers. I'm more of your newbie spirit guide into the Bitcoin world, which is confusing, strange, weird. As John Oliver puts it, it's everything you don't understand about money with everything you don't understand about computers. And so my job is to help try to make that a little bit more simple.
Bit of a Bitcoin educator. So we're excited to have you here this afternoon. And as I mentioned before, this is our university edition. And our focus in this edition was to invite student blockchain partners to come ask questions and discuss groundbreaking new technologies with some of the most influential thought and business leaders in the industry. In that vein, our company MouseBelt has been working with more than 80 student blockchain organizations from universities spanning multiple continents, providing support in a variety of ways, from internships, office hours, sponsorships, as well as early stage products investment. And today I have joining us on the panel, my co-hosts, Kunal Arora, Vice President of Education, and Punn Kam, Head of Engineering at UC San Diego, and Sam Ruskin, President at the Ohio State University Cryptocurrency and Blockchain Club. Now, gentlemen, in just a moment, before we move on to the interview, I'd like you to tell us a little bit about your club, how many members, maybe some of the outlay of the majors of your members, and what activities y'all have involved, and maybe something that y'all have recently gotten into. So we'll start down in San Diego. Why don't you go ahead, Punn? We'll go over to Kunal.
Yeah, of course. Thank you so much for the introduction, and very nice to have you, Dan. Just want to talk a little bit about our club. So I think now we are about a year old, and initially we started off as a club that simply focused on education, trying to onboard as many people to crypto as possible, starting with Bitcoin, obviously, and spanning out to multiple other applications of blockchains. But now I think, given the maturity of the club, we've started to shift our focus much more on actually engineering and build out the club in terms of actually having projects that people are working on. So students will be contributing to different projects, and they could use these projects to either spin them off into actual startups beyond the club, so they can kind of just detach themselves from the club, or they can use those projects to learn and use those skills to contribute to other startups that other people have started. So I think that's our main focus right now. I think the makeup of our club is very much an engineering focused club. So a lot of computer science students, some economic students, but even the economic students wants to explore computer science and programming. So that's another very, I think, interesting aspect of the club is we're actually shifting people who are not really from a traditionally technical background to to training themselves up in a technical way. So I think that's one of our focuses. And as the lead of engineering, I hope to promote that shift, that transition, and also just strike a healthy balance of both, because engineers sometimes overlook a lot of the business economics aspects too. So yeah, definitely want to keep both of them in check.
Totally. Yeah. What sort of economics do you guys teach there?
So for economics, the club itself doesn't really teach that much economics. We provide some sort of like resource page that people can access to learn about tokenomics themselves and like mechanism design and whatnot. But directly from the club, we don't really provide any economics education.
Bitcoin's and money, right?
Yeah, that's definitely true. And I think a lot of the economic students have brought a lot of very interesting insights regarding, I guess, the usage of Bitcoin in the overall global financial system. So some of the engineers are actually learning a lot from these business students too. So it's pretty awesome.
Gotcha.
Maybe Kunal can talk about some of the education efforts over there.
Yeah, we had like an intro to blockchain course our first quarter, which was like 5-part series talking about, how consensus works on a very high level, or how like what are the different projects built. And then we had like a boot camp, but that was like a bit more technical, going through Solidity. So yeah, we have like, as a club, we have realized like there's an oversaturation of resources which go over like intro to blockchain stuff. We rather have like something a bit more specialized, going over a paper or going over something more academic, rather than, just going over the same thing over and over again. So that's our focus for this quarter. We have like people outside who have been doing some research come and talk about what they've been doing, or students ourselves, like if someone's working on like decentralized identity, how are we implementing that? How are we trying to solve like Sybil attack, the problem of Sybil attack? So yeah, that's it from education.
Really utilizing that think tank environment of the college, really helpful. Like I was saying to Mr. Ruskin before, it's a great time to be in school while this is all happening. So I'll let Sam introduce himself.
Thanks. So our club takes it from a slightly different perspective. We're definitely a little bit more finance focused, and the main people we attract are probably finance majors, any sort of like business, so like information systems. That being said, completely open to computer science programs, and we're trying to direct more projects to them, just because we recognize that it's as valuable as the finance perspective and the business perspective, like my co-hosts were saying. So we think that if we can build an environment that allows people to create projects, like they were just saying, that they can spin off from the club, that's like the most beneficial thing that we can give them, is that like community aspect, and give them the resources to teach themselves about the technology, because you can lead a horse to water, but at some point it's on everyone else to kind of take their own journey to learn about the technology. So the best thing that we like to do is engage in like trading competitions where we try and teach technical analysis strategy. We bring in guest speakers from Columbus and from, I mean beyond Columbus. We have had some people from LA and from San Francisco come in and speak, which has been great. So helping students to break in from a non-technical perspective is something we're really passionate about. But again, hoping to break in a little bit more from that like computer science angle and introduce some more discourse on like that end.
A little bit more of a finance angle out there. We'll go ahead and toss it back out to Ohio to go with the first question. And just because one side or the other is asked a question, don't hesitate. If you've got a natural follow-up, once there's a lull, I'll try and redirect, or I might ask a follow-up. But feel free. This is a conversation. So if you'll go right ahead, Sam.
Great. So I guess we'll just start off from kind of like a high level. In your opinion, what do you think is required to accelerate the move from CeFi to DeFi? And do you think that we have the infrastructure and enough public knowledge of blockchain technology to coordinate like a safe transition to a financial system built on crypto?
Yeah, so there's a couple. Yeah, there's two questions there. One is around the educational component and how to move a nascent technology into like mainstream adoption. The other one is around a stable journey or a linear transition to that new paradigm. I'll start with the second one. So nothing in life is stable, and there has never been a transition that has been super smooth. I think any major step function or magnitude shift usually is highly disruptive. That's why a lot of like startups in Silicon Valley and different conferences are called like Disrupt or something like that, is it's about disrupting the status quo. When you disrupt the existing underlying financial system, that typically does not happen in a nice linear format and will likely be a somewhat volatile event. This isn't a bad or good thing. Volatility or stability are not inherently good or bad. It just, I think, when it comes to replacing the existing foundation of the entire financial system, it typically doesn't happen where you swap out. We're talking like upgrading a glider into a jet engine aircraft, and that doesn't happen without substantial changes happening to the entire body, the engines, etc. So I think that it'll probably happen in fits and starts. I mean, as you all probably have been noticing, over the last month, we've had gigantic macro events occurring. Sovereign bond defaults becoming more and more likely. We're seeing those sell off as the creditworthiness of nations, which are the largest creditors in the world, are called into question. So these moments are not very stable. These moments are like Six Sigma sort of movements. And this isn't a bad or good thing. It's usually what happens with a centrally planned system, is they suppress volatility over the long term, which then eventually bubbles up and leads to highly volatile, kind of like very short-term movements like we're seeing now, or the 2008 financial crisis. Regarding how do we get people to adopt Bitcoin, how do we get people to understand why decentralization, why crypto, why Bitcoin is important? I think it's primarily user experience focused. I think that the space has an incredibly high saturation of developers. I think what's lacking is a lot of UX UI designers, so user experience, user interface design. I think Bitcoin wallets have abysmal UX. So do most DeFi applications. I think most users don't understand the actions that they're performing. I think in conjunction with UX UI design, you need better product marketers. So product marketers going in and establishing some sort of educational and knowledge, like educational backing when users are performing these transactions. A lot of them, for example, like most users don't really understand what they're doing with yield farming. I'd say a majority think it's earning yield on their underlying assets, which is quasi true, but it's more of they're taking bips on volatility. So as two assets in a pool are traded back and forth, they're earning a fee on that, but there's something called like impermanent loss. Now, the balance of this, of like simplicity and getting them into the product without overly concerning them. For example, you wouldn't require everyone to read the entire manual of a car before they drive a car. I do think there's a sliding scale of marketing related copy, design, and those working together within these user interfaces, whether it be a Chrome extension, mobile app, etc., to better educate folks about what they're about to go do. I think that's predominantly the biggest hurdle, combined with just overall education. Most people come into crypto for speculation. Let's not kid ourselves. I did back in 2011. So it's most of us came in because it's a speculative asset and it's fun to make money. And the volatility is naturally a draw, because we're not just talking about making money, we're talking about 10xing or 100xing. So I think that is the predominant user acquisition loop in crypto, but the education is what keeps people around and keeps them around for example, with Bitcoin, the sound money, or Bitcoin being a world reserve currency, that narrative. So I think overall education, we still have a ton to do. There's a lot of great people doing work out there. There's hundreds of me, for example, that go out there and create content to help convert these speculators into long-term hodlers. So there's that, combined with, I would say, on the product side, UX UI designers, plus good product marketing managers that effectively communicate actions within the product or protocol for folks to better understand what they're doing.
Well,
Gotcha.
I definitely, thanks, Sam. I definitely did not come to the space originally as a speculator, but I definitely came back. I cannot kid myself. I was a crypto kitty. I was really interested in encryption. But about this DeFi, I believe Punn, you might have had a question regarding some of the DeFi, the wider DeFi stuff.
Yeah, so I guess my question would be for DeFi in its current form right now. Do you think there's some sort of aspect of the current ecosystem of DeFi that is portable to something like a Bitcoin DeFi or a Bitcoin's version of DeFi? And how do you foresee that type of DeFi kind of blossoming?
It's a really good question. So first and foremost, Ethereum, Solana, and these other chains have a vast majority of DeFi-related activities going on, and for good reason. These blockchains have been special purpose built to be smart contract platforms, aka DeFi-related platforms, or the ease of a developer developing an application on top of one of these chains is far easier than, for example, Bitcoin or another type of chain, or like a Litecoin, for example. There are two kind of components to think about when building on top of a blockchain. One is, does it have all the cool stuff? Does it have the composability? Does it have all these really cool developer related features? I would say that's one big thing that most developers over-index on. And the other is economics. So, when we look at the economic foundation for Bitcoin, like the credibility of its monetary policy, Bitcoin has the only, I would say, credible monetary policy in crypto. The credibility of the monetary policy isn't just rooted in code, it's rooted in the community culture. For example, it's the least likely that the Bitcoin community would come together and change the 21 million hard cap. But with Ethereum, their monetary policy has constantly changed. And so I think it requires both considerations of both the smart contract capabilities and the soundness of the money in order to understand what you're building on, because you've got a lot of flexibility with the composability, et cetera. We can build these DeFi Legos on top of each other. But if you don't have a sound financial, like a sound money at the bottom of that, then you're sort of building on top of sand. And we haven't seen something like that happen yet, but these events are very, very rare events, right? Like the game theory behind Bitcoin and Ethereum, the game theory that's playing out, some of these may not happen for a decade, but then if it happens and there's a catastrophic failure, then all of the economic activity on top of that chain is, basically goes to zero or is severely damaged. So that's where I think Bitcoiners are, I would call them a little overly cautious, but not for bad reason. If you're going to build this system, you want to make sure it's extremely stable. So with DeFi, I often say that like Solana, Ethereum, they can do a lot of cool shit. And they trade off a little bit of decentralization here and there to do more cool stuff, which isn't a good or bad thing. It just depends on how much decentralization do we need for these chains to survive. Bitcoin could have overly indexed on decentralization, which means it will have sacrificed all of that cool stuff in order to remain decentralized, but maybe nation states never attack it. Ethereum and Solana may have traded off some of the decentralization, but we could find out that indeed they traded off too much, and we won't know until that moment happens. There's a term from the Fermi paradox called the Great Filter Event. We don't know if the Great Filter Event is behind us or in front of us, where most blockchains might die. We have to remember, of course, blockchains were created to survive state level attacks. If those attacks never happen, then trading off decentralization is fine. If they do happen, then 99% would likely collapse. And Bitcoin would even, Bitcoin being, I would say, like the most battle hardened, it's still a risk, right? When it comes to saying like, hey, can these things come back to Bitcoin? I do think Bitcoin has a lot of interesting things going on for it. If we want to define DeFi, I probably should have started with this. DeFi is a pretty ambiguous term. People use it interchangeably to represent a lot of different things. For example, algorithmic stable coins are called DeFi, and same with like USDC is called DeFi, but USDC is completely centralized. USDC or any smart contract based on USDC could be instantly frozen, and that smart contract would lead to a cascading loss or failure event. So when we use the word DeFi, I'm going to loosely say that activities existing on a blockchain and a smart contract functionality. I think that's what colloquially most people are referring to DeFi as. With Bitcoin, you've got some DeFi that's being built on top of it. So Bitcoin isn't composable. It can't do a lot of that cool stuff out there. But it does have things like Lightning. And Lightning allows for Bitcoin to scale up transactions wise to millions of transactions a second. And then Lightning with Taro can add other assets on top of Bitcoin. And so you start to build out some of this more advanced smart contract functionality and layers on top of the Bitcoin layer, on top of Bitcoin layer 1. So not existing on Bitcoin layer 1, but existing on layers above that. That usually means it's a little bit more clunky. It's definitely not composable, which is a good and bad thing. The lack of composability means that these are single purpose applications, which are far less likely to lead to cascading failures if you build DeFi Legos on top of DeFi Legos, because they're more single function. For example, discrete log contracts allow you to essentially pipe in external data and then have a bet be paid out given that external data being piped in from an oracle. So that's a pretty cool advanced smart contract functionality that is currently existing in Bitcoin as a company called Atomic Finance, where they're doing Bitcoin options on top of the Bitcoin network in a decentralized manner. So you've got that, you've got like Stacks, you've got RSK, you have Liquid. Those are all more sidechain-esque. All of these represent different layers that you can build the smart contract functionality on top of the Bitcoin network. It's not as clean, it's not as elegant, it's harder to work with, but I do think that by the year 2024, this all of crypto is about is predicting narratives and predicting that narrative reflexivity loop of narrative, price, adoption, funding, et cetera. I do think that Bitcoin DeFi will become a pretty large narrative by 2024, where there's a lot of people building now, and Bitcoin can take back a lot of that smart contract functionality. It definitely can't take back most of it, but it can take back a good portion of it. And I think that a lot of people, you know, if you look at WBTC, WBTC has wrapped Bitcoin on top of Ethereum, where there's a totally centralized custodian, BitGo, that takes the asset and then tokenizes it and puts it on the Ethereum network as an ERC20. You know, these sort of things I think are indicative of demand to use Bitcoin in a DeFi sort of setting. So I think there's a lot of demand to use Bitcoin as this pristine asset, that its monetary policy is one of the best, I would say is the best in the world compared to fiat and crypto, and combine that with some smart contract functionality. So I think by 2024, we're going to see a lot more activity occurring in Bitcoin DeFi, but it definitely can't do all the cool stuff that the other chains can do, though.
Maybe we could follow that up with Kunal if you had anything. Otherwise, I do have something right on the back of that.
Yeah, I guess I was gonna ask like what's like the comparison between like DeFi built on wrapped BTC versus BTC, but you like answered that question already. So
I guess I could reiterate it for the audience if they're curious.
Well, so I have a little bit of maybe a bit more nuanced question that might dig into it a little bit, is that the differentiation that you're making there between the two blockchains is akin to, I think, to newcomers in the space, gold, physical gold, versus I go out and buy gold stock, right? That's wrapped Bitcoin on the Ethereum blockchain, because once I have this pristine asset, as you said, over somewhere else in a more centralized environment. Now, maybe we could talk a little bit deeper about the merge and how those things kind of made it fundamentally different than Bitcoin for people who, I heard that there was a merge, but I'm not sure what that meant.
Sure. Well, where to begin? I would say the most simple explanation of the merge is that the merge is a long-awaited transition of the Ethereum blockchain going from proof of work. So proof of work is a mechanism that uses real-world energy costs to validate something in the digital world, or using real-world energy to secure a blockchain is, I think, the most simple way to put it. You've got the transition from that to something called proof of stake, where instead of proving that you did the work, you prove that you could do the work, or that you have stake or collateral at risk. So this is a pretty big transition for the Ethereum blockchain. It comes with, I would say, like a lot of very, very risky maneuvering. Going back to our airplane analogy earlier, if the existing financial system's a glider and this is swapping out, jet engines on the glider, this would be using some sort of very fancy new type of rocket engine, or some very fancy new type of engine that we don't even know about, maybe like a scramjet engine, where it's a little bit more theoretical. has a lot of touted benefits, but could also, risk that the craft potentially has an issue or explodes or something like that. I think a lot of the Bitcoin community has been a little bit dishonest with the framing of how risky the maneuver is. They've been studying it for years and years and years. And so while that being said, so I think some of the Bitcoiners overly emphasize how risky it is. There are some things that are basically unresolved. So here's a couple easy ones. For example, let's say that due to the Ukraine-Russia conflict, Russia cuts off internet cables from Europe to the US simultaneously. So we lose connectivity to Europe, let's say for one day. Well, the stakers in each of those geos, the chain will inevitably split into two. How do you reconcile which chain is the correct chain? That seems like a simple thing to reconcile. And with proof of work chains, it's incredibly simple. It's whichever chain has the longest accumulated proof of work. And that is done without anyone choosing that. It's literally just provable which chain has the longest proof of work. But with proof of stake, it would require a political, basically, vote of individuals coming together and choosing which is the canonical chain. I consider that to be a very highly probable incident in the next 10, 20, 30 years, whether it be a solar flare, political, economic war, whatever it may be. There probably will be a moment when internet connectivity gets cut and there's partitioning of the internet for just a brief period of time. That's an example of an unreconciled, I would say, like pretty critical tail risk event. You've also got one too that is actually happening today with censorship. So with stakers, and I'm overly generalizing here, and I know that the engineers in the room are probably cringing because I'm losing some of the facts. I'm trying not to frame this too dishonestly or anything like that. I'm trying to gloss it over so normies can understand here. With a proof of work system, miners are compensated with the block reward, newly minted Bitcoin and transaction fees. And they do that by expending work. Now, there are many, many Bitcoin miners working across the world, and they join Bitcoin pools, which smooths out their payout schedule. Skipping forward a little bit, these pools can decide which transactions are included in a Bitcoin block. Now, currently, they're not censoring any Bitcoin transactions. That's not occurring. Now, game theoretically, it could, where a government says, hey, pool located in this country, we don't like the fact that you're processing transactions occurring in Azerbaijan or something like that. So game theoretically, the pool could start to censor transactions. Now, Bitcoin miners can almost immediately switch from a pool and allocate their hash rate somewhere else to another pool that's not doing that. So that's defense number one. Defense number two is that Bitcoin miners are financially incentivized. If no one mines a Bitcoin if there's a Bitcoin transaction in the mempool and no one's processing it because they're afraid it's a dirty transaction, the transactor will just simply bump up their fee until someone chooses to process it. And at some point, the market dynamics of the free market will find a price that people are willing to take the risk. So that's how the Bitcoin game theoretic, processing works with Bitcoin transactions. And like I would say, like a highly censorable sort of environment. With proof of stake, there's a pretty big flaw, and this is already occurring with 20% of all Ethereum blocks, I believe, with I forget which company is currently doing this, but Tornado Cash was a Ethereum mixer, which mixed transactions together. And so OFAC said, hey, any transactions going to and from the smart contract address should be flagged or shouldn't be touched. So with Ethereum stakers, though, the problem is you've put capital at stake, and you are required to process all transactions occurring on the Ethereum blockchain and not engage in censorship. If you do engage in censorship, you can be slashed, which means your principal amount that you've allocated your money at stake can be whittled down and cut down as a penalty. And that's a pretty substantial issue because it occurs very actively. So you're either staking or not staking. And if you're staking, you can't be selective at all with transactions. And then two, it's extremely, the time duration to stake and unstake is very, very long. The reason why it takes such a long time to stake and unstake is due to long range attacks and other game theoretic attacks that could occur if you could stake and unstake very quickly. So the problem with that is there could be tons of capital at stake And then governments could come down and be like, hey, we want you to censor these transactions. And big companies like Kraken and Coinbase, Kraken being my former employer, would be in a bind, because if they don't continue to process transactions, then it could be slashed and slash all their customer funds. If they do, they could be in violation of something, in violation of like a new regulation. So proof of stake versus proof of work, you know, those are some of the game theoretic negatives. Some of the positives: some people say that proof of stake requires less energy. So less energy using to validate and protect the network. I actually find that more of a negative personally. Proof of work is not wasteful or dirty, just like how I don't think you using Christmas lights on your front lawn is like wasteful or dirty. It's subjectively your use of energy. I don't care about your porn watching behavior or if you watch the Kardashians or not. I'm not here to morally like weigh in and subjectively say that's wasteful or this isn't wasteful. People use the Bitcoin network. The Bitcoin network is allowing people to store value that's hard to seize with a monetary policy that can't be changed and transact with anyone in the world without censorship. I think that's pretty fucking valuable. So I think Bitcoin's energy consumption is an awesome thing. Also, I think game theoretic wise, proof of work roots in real world energy costs to protect something in the digital world. And I think there's something beautifully simplistic about that, that from a game theoretic perspective, I really, really like long term. But I'm not like an anti proof of stake individual. I just think they have different game theoretic attack vectors. And personally, I just like proof of work more. But I'm not here to say I think proof of stake is terrible or something.
No, it just has always seemed to me, as you kind of alluded to here, is that it's just a little bit more capitalistic in the sense of how it versus my hash power went from the search for extraterrestrial intelligence to, you know, Ethereum, and now it's, you know, somewhere else. So it's, you know, standing on my home server, but and a little Monero. But we'll throw it back out to Sam. I believe you had something else up in Ohio.
Yeah, so I guess it kind of goes along the line of what you were talking about with Bitcoin versus other L1s and everything. But do you see any sort of interoperability between future chains? Like Cosmos is really taking a huge stance on like the benefits of interoperability, and I know like Ethereum is starting to accept that more, and same with like Polygon and like there's like ZK rollup protocols. But I guess, do you see a future where there's a lot of interaction and in between all of these different blockchains? And yeah, I'll just leave it to you to answer that.
Yeah, I mean, I certainly think interoperability will be even a stronger narrative by 2024. With any interoperability between chains, you're usually having some sort of trusted setup or trusted scenario or semi-trusted scenario where, you know, like you've got bridges, for example, that bridge assets from one chain to another. Those require either a completely trusted setup like WBTC with BitGo. They take Bitcoin, they're totally centralized, they wrap it, make it an ERC20. Or you've got things where like people are posting collateral at both sides of the bridge, and that is sort of like secures the assets that flow from one to the other. These all come with trust trade-offs. And I think they come with trust trade-offs that inevitably are like weaker than the existing L1's trust trade-offs. For example, the L1 being Ethereum or Bitcoin. And so I do think that while it will be a big narrative, and I think people will be excited about it, I find it kind of strange that there'll be all of these trust minimization. I don't think that, or trust, you know, people adding more trust requirements to these blockchains. I do see money long term. So if these chains are competing on money, which I think Bitcoin's only the biggest one that's only really competing on money. The rest are trying to be like more of like their native token is like gas, like a smart contract processing sort of fuel, if you will, or that's how Ethereum was originally pitched. I do think though that, you know, eventually people converge upon an asset where they want the asset with the most, I would say, advantageous traits as a money and advantageous community and thought process around changes to the protocol. You know, if changes occur too quickly or changes occur very often, for example, like Solana going down again, I think Solana went down again, I think for like the third or fourth time this year, which I actually like Solana a lot. I think it's interesting. You know, I think they trade off even more decentralization than Ethereum, but they focus more on user experience, like lower fees and faster confirms, or just for a human just seem faster and better. Right. So, and I think the Solana community has a really, really big community. So I think, when we look at it, like when we look at, look at where does this end up in 20, 30 years, it would be very surprising, I think, if we had thousands of L1s. I think that would be a more surprising scenario than a handful of L1s. So if I were to bet, I think there's a handful of L1s in 20 years rather than thousands.
Gotcha. Yeah, I definitely take like a similar stance. And kind of on that point that you were talking about a little bit earlier with Bitcoin as money, do you think the way that Bitcoin is regulated is going to affect how it is used? And especially like in that sense by the people who like stand to benefit the most, which are like the unbanked people across the world. So you have like the hundreds of millions across Eastern Europe and in Asia and in Africa, and they're really looking to Bitcoin as like one of the solutions to keep their money in like a store of value. So is the way that Bitcoin is regulated as a commodity or a currency going to affect its presence as a solution?
Yeah, great question. I mean, we could talk about like the US regulatory regime versus everyone else. We've got a super burdensome regulatory regime. So when it comes to like emerging markets and people adopting Bitcoin, most of those governments have pretty permissive or pretty lax governance over Bitcoin, or like have pretty advantageous tax laws. For example, in Germany, if you hold Bitcoin over a year, the tax is 0% long-term capital gains, which is cool. Versus in the US, like every single thing you do in crypto is a taxable transaction. So I don't think it's going to be that big of an impact. Certainly recently with like the SEC talking about different assets as securities, I think that could be a pretty negative headwind for assets that might be labeled a security, which Bitcoin's labeled a commodity or a property by the IRS. So it wouldn't fall under that. I'm not here to say that I'm a huge fan of like the SEC coming in and labeling things as securities or not. And I certainly, as a free markets guy, while I'm a biggest fan of Bitcoin, I don't wish ill upon everything else. And I don't wish that like the SEC comes in and cracks down on everything. That's not a wish that I have. But it certainly should be a concern for assets that are more similarly resemble a security. And the US financial system does sort of set the tone for the rest of the world. I don't wish that to be the case. I don't want that to be the case, but it is increasingly looking like that may be the case. I do think that Bitcoin's primary value proposition is in the two things it does super well, or the three things it does well is you can store something and it's really hard to seize. So if you store it on a Trezor or Ledger, you can go stash that away and it's super, super hard for someone to seize that from you if they don't know where it is. If you have a transaction that you want, to be sent in a way that can't be censored, it's super valuable for that. And then finally, a monetary policy that can't be changed. And so those benefit different people depending on their jurisdiction. So for example, Silk Road benefited mainly Westerners who wanted to transact to buy drugs online. And so that highlighted the censorship capabilities. I think right now, most people are holding it for the monetary policy and seizureship capabilities, which is that I can hold an asset and I know that the monetary policy won't change. Yeah, the price is going to change because people's belief in Bitcoin vary, but at least long-term, I do think that there'll be immense value accrual to Bitcoin to where Bitcoin should hit tens of trillions of dollars in market cap because it does represent something stable, something real that we can trust versus a bunch of old men in suits on stage who tell us, trust me, I know what I'm doing. And you're like, you guys have no idea what you're doing. You didn't predict inflation. You weren't able to control inflation. And I'd rather trust this math and this code backed by a community that won't ever change it. So I think that that's Bitcoin's biggest value proposition. And I think that that's a kind of a global need. Like people need to park wealth where the monetary policy can't be changed and where it can't be seized. People can want to do that everywhere. And I think even in the US, it's becoming even a bigger issue as we're seeing capitalism be kind of thrown under the bus as this evil thing and socialism rising. I think asset seizureship, or AKA taxes, will become increasingly more popular. I mean, Biden tried to pass a tax for unrealized capital gains, which taxing unrealized capital gains, which to put that in context, no country in the world currently does that, and would make which would crater the US economy and ultimately lead the US economy down, I would say, like a very, very socialist leaning, anti-free market sort of lean. So I think Bitcoin is that antidote, and it's a pretty good antidote in both, Europe Asia, US, South America. It's a good antidote for that anywhere. Because even in countries where we thought we had pretty good, strong property rights, we're slowly seeing those property rights, the ability to own an asset, be slowly eroded away by extremely socialist sort of leanings.
Ironically, thanks. We did have an SEC commissioner on who said that Americans are too willing to have their transactions surveilled. And I can't say anecdotally, from my time when I was in Mexico, even in places with very, very limited cellular connection, they were using point-to-point, taking Bitcoin though, and USD, Bitcoin, pesos on the sign. So we'll throw it back out to Punn if you had anything follow up. We got one more round.
Sweet, yeah. Yeah, I just wanted to run back to, I guess, the argument for proof of work. I think I agree with a lot of your points that, yeah, proof of work is definitely very decentralized compared to, I guess, Ethereum now that it's changed to proof of stake. I was wondering if you had any concerns about, the cryptographic soundness of Bitcoin in, I don't know, 20, 30 years, just because of maybe not so much quantum computing, but just because of the mining rewards that is dwindling, I guess, every 4 years. And eventually it will be pretty small, I would assume, given the 21 million supply cap. I was just wondering if there was any like game theoretic consequences or side effects of that, and maybe is there any other way we could kind of curb that negative side effect if there is one?
Yeah, this is a very common conversation in this space. I wrote extensively about this 3 years ago, so yeah, happy to dive into it. For those who don't know, whether it be proof of stake or proof of work, there is a block reward that is given to either the staker or the Bitcoin or a proof of work miner in compensation for putting up their capital at risk or provably expending energy like proof of work. So the way that Bitcoin's security model works, so the security model is the game theoretic incentive model for the Bitcoin miners to behave properly. So it's like, hey, miners, and by the way, Bitcoin miners do not control the protocol. They are compensated in the form of Bitcoin. So if they were to damage Bitcoin in any sort of way, they would damage all of their future cash flows. So they would be wanting to willingly burn the money. That's what's really cool about Bitcoin and proof of stake game theory is it's like, well, you're rewarded in the native asset. So if you bought machines and tried to destroy Bitcoin by trying to like reorder transactions, aka a 51% attack, by doing that, you damage your future cash flow. So you have to be willing to burn your money and burn it to zero. And Bitcoin ASICs are only usable for one thing, to mine Bitcoin. There is no other purpose for a Bitcoin ASIC. You can't take it and repurpose it to fold protein or anything else, like do protein folding simulations or anything else. So Bitcoin miners buy these specialized machines to spend it and put energy through them in order to receive a block reward. The block reward is comprised of newly minted Bitcoin, called the subsidy, and transaction fees. Over time, the subsidy or newly minted Bitcoin declines in an asymptotic fashion. So more Bitcoin were issued in the beginning of Bitcoin. This is time here. And here's the number of Bitcoin issued, and there'll be up to 21 million Bitcoin issued. And that occurs every 4 years in an event called a halving, which dictates the amount of Bitcoin subsidy or newly minted Bitcoin produced in each block. As the amount of newly minted Bitcoin in each block drops, over time, transaction fees eventually need to compensate for the drop in subsidy, hence why it's called a subsidy. The reason why is we need to have a large enough value to incentivize Bitcoin miners to behave properly. Basically, they need to receive, if they only received a Bitcoin block reward that was worth $1, well, if I'm willing to spend a very low amount of money, I could go, perform a 51% attack. So we all know this is happening. Everyone sees this happening in the protocol. We've already had a couple halvings, and we can see each one perfectly programmed into the protocol, but we're not seeing transaction fees rise as much as we'd like. So there's a couple different ways to think about this. One, even though the subsidy is decreasing over time, Bitcoin's value is going up exponentially, which means that, while the subsidy has declined dramatically over the last 10 years, Bitcoin went up 10,000x. So the transaction fee, the block reward, the subsidy component of that has never been higher in a dollar term. Now, of course, intra-year cycles, it's down from its peak, but just generally speaking, from like 5-10 year windows, it's up quite a bit. So one, if Bitcoin's value keeps rising, that does delay the subsidy issue longer and longer. Two, transaction fees. So the demand for Bitcoin block space, how many people want to perform a transaction in a Bitcoin's block space. I do believe that that will rise over time, given more smart contract functionality, given more Bitcoin DeFi that will occur. And that's why I'm a big proponent of bringing DeFi back to Bitcoin, because it creates more demand and more transactions on the Bitcoin network, which is good for Bitcoin's security model. And I do think from a marketer's perspective, if you think about all of these trading activities as games, like yield farming, NFTs, staking, lending, borrowing, these are all financial games in a way. And Bitcoin only has one speculative game, which is like the spot trading of Bitcoin or futures or options. But the more speculative games we can bring back to Bitcoin, I think the more transaction fee demand we'll see, and more user adoption as more and more people get interested in it in order to go speculate. And so I think Ethereum and Solana are a testament to that, of the amount of speculation occurring over there. We have seen that lead to like long-term user adoption, and also kind of long-term value accrual for block space demand. So that's a long-winded answer to say, we don't know what an appropriate level of security spend is. We don't know if it's 10 billion, 100 billion, 5 billion, 2 billion, or percentage of stock or flow. But what we do know is more is better. And I think we'll be okay, generally speaking, in 5-10 years, where there's be more transactions on the Bitcoin, and more demand for Bitcoin block space, and Bitcoin's price will be higher. Here's one last thing to leave here. A lot of Ethereum folks like to point this potential issue out. That's, who knows how long this issue could be, 5 years from now, 10 years from now, 20 years from now, 50 years from now. What I find funny is Bitcoin's block reward was a lot less 5 years ago, and it wasn't, no one attacked it or destroyed it. So Bitcoin's security model was worth far less in its earlier stages of development and versus now, and we didn't see it get attacked then. So it's only getting stronger in terms of total dollar value. So I always find that one funny, because it's like, well, they're like, well, we don't know what an appropriate level of security spend is. And I'm like, exactly. I have no idea what an appropriate level is. So TLDR, I don't think it's an issue. I think in 5 or 10 years, we should see if it's an issue, but I don't see it being an issue. I think that there's going to be, Bitcoin's price will go up, and there will be adoption of Bitcoin block space.
Very cool. Very cool. Sam or Kunal, if either one of y'all have a burning desire, we're coming up right on the end of it here. So we got time for one more. I'll let Kunal, unless you don't, and I'll throw it to Sam.
I had a quick question. What's like the scope of like MEV on Bitcoin?
The what?
And MEV?
Yeah. So miner extractable value. So basically miners can reorganize. So what he's referring to, for those who are listening, what he's referring to is the Ethereum miners looking at the sequencing of transactions in a block and reorganizing the sequence of transactions in order to extract value. Also, I think in more common terms might be called like front running, or how do they advantageously position their own transactions or others' transactions to maximize revenue. For example, like if I see an order for a certain asset, I can front run that. So miner extractable value is the term that he's using. With the Bitcoin network, it depends, with layer one, there's not, with like, for example, Taproot that came out. So Taproot and other smart contract, I would call that like a smart contract. With some of these, they obfuscate the original type of transaction. So it depends on if the original transaction type can be seen on layer one or in the mempool. If it can be seen in the mempool, then there's an opportunity for MEV. But with the Bitcoin network, it's far more simple. Unless I would say like it doesn't have ERC20s, it doesn't have all these different capabilities on L1, which does reduce its functionality, but also it makes certain transaction types, and Taproot just enabled this, by the way, about a year ago. It makes like the opening and closing of a Lightning channel indistinguishable from a normal Bitcoin transaction. And so with other smart contract types, Taproot and other types of new Bitcoin scaling smart or scripts or smart contracts can obfuscate the transaction type, which would reduce MEV. But MEV will always exist on any block space or any mempool, as miners will want to look at transactions and reorder them in a certain way that will be advantageous for them.
Thank you so much, Mr. Held. We're coming right up on the end of it, so I'm going to say thank you to my co-panelists, Kunal and Punn out at San Diego, and Sam up at Ohio State. Thank you once again to Mr. Dan Held, Bitcoin educator, and we're going to hold on and watch and wait for that Bitcoin DeFi that's coming up in the next couple years.
Well, appreciate you guys having me. Really appreciate all the questions. Those were very thoughtful, very, it was fun answering them. I think those were all like very in-depth, good questions to ask. And yeah, wish you all the best on your journey.